What's up everyone and welcome back to the channel. On today's video, I'm going to show you a trading strategy that can make you $100 a day trading the SPY, which is an ETF that tracks the S&P 500. It's extremely liquid, high volume, and trades options every single day. So you can get into some positions that provide great potential reward daily and use this strategy time and time again. The purpose of this video is not to guarantee that you're going to make $100 a day, but to show you a strategy that you can implement into your arsenal of potential trades to help you make more money in the market. But like I said, nothing is guaranteed. Sometimes trades go against you. Sometimes you're going to get into this position and it's not going to work. That's okay. It's about improving your trading and getting a higher percentage of wins so that you're more profitable, you can scale up your account, and you can grow the amount of money that you make every single day in the market. Now, these are trades that I post whenever I get into them, and you can have the live trade alerts if you join the private Discord server. A link is provided down below in the video description. So what we're looking at right now is the SPY chart, and this is we're going to go to the 1 year, 1 day chart on Thinkorswim. So each candle represents one given day of trading on the SPY. Now there is a pattern here that I want to show you, but before I do that, I just want to say that something as high volume as the SPY and as liquid as it is going to respect technical analysis more than an individual stock. So part of this strategy is to draw supply and demand zones or figure out where those prices are. And if you want to learn more about that, there's a separate video. Using those support and resistance or supply and demand zones will help you determine when to get into a position, along with some other technical analysis as well, such as moving averages, trend lines, and some other things. Another thing that is very important is momentum in the short term with the SPY. Trying to figure out the direction of the market on a day-to-day basis is extremely tough, but using these tools to help us predict the movement and finding those right risk to reward ratio trades will help us be better traders. Now, the pattern that I want to talk about is how the market likes to use momentum to continue a direction after a big move. For instance, just in the last week alone, if we zoom in on some of these candles, we can see that large green days are followed by at least one more day in the green. For instance, large green, another day in the green. And the same thing can be said for large red days. A red day, a red day. Let's zoom back out and find more examples, and it will be more apparent that the pattern is there. So here we go. We had another large green day followed by a green day. Let's zoom back out. Here we go again on the flip side. A large red day followed by some more red. Green day, engulfing bullish green candle followed by another green candle. We zoom back out. You're going to see this time and time again. Green followed by green, even some more green. Large green day, another green day. Large red day, another red day. We zoom over here. We can see that it started to move down quickly. There was consecutive days in the red. Here on the flip side, a nice gap up on green, another green day. Here again, big green candle followed by more green. Nice red candle here followed by more red. Here is an example where it actually didn't happen. You had an engulfing bullish candle and it actually closed lower on the next day. So this time it did not work. It's not always going to work, but if the pattern is there, the chances are that it's going to work more than it doesn't is relatively high. But nothing in the stock market is guaranteed. So if we look at what's happening right now, and this isn't as clear because if we zoom in, you can see that we have 3 red days. But what actually happened is the market gapped up and it doesn't show it being green on the SPY. If we hover over this candle, we can see that it closed at $410.93, and this candle opened up at $413.88 and closed at $412.85. So in my mind, that is actually a green day because we closed higher than the prior close. We just had such a large gap at opening because on this day alone, we had CPI, which shot the market higher in pre-market. You can look at the short-term futures. If you type in MES, you will then see this a little bit more clear on the daily candles. Here we are. You can see that we're actually seeing some green. So taking this information, heading back to the SPY, we can then say that we are bullish for tomorrow on the stock market. So what kind of trading strategy can we get into? Well, obviously we're going to be using options if we want to make $100 a day in a small account, say $1,000 account. So what we're going to do is we're going to go to the options chain. And what we're going to do is we are going to pick options that expire tomorrow, basically 0 day to expiration options, because we're filming this in after hours. Now I'm going to adjust the strikes not to be all, but we'll go to 14 because we're going to be pretty close to the money. We are making a bet on the direction. So if we think the stock is going to move higher, and with it being at $412.85, let's say that we think it's going to be above $413 by close tomorrow. 413 minus the current price divided by the current price is a 0.03% move. So it's no move whatsoever. It just needs to be slightly positive. So what we're actually going to be doing here is we are going to do something that might seem counterintuitive, but we are going to be trading put options on the SPY. We are going to get into what's called a put credit spread. So what we're going to do is we are going to right click and we're actually going to sell and do a vertical. And we are going to sell the $413 put and buy the $412 put, and we're going to receive a $37 credit for that position. If we do 3 contracts, that is going to put us over $100 on the day. Now, if I was to right click on this and I was to go to analyze trade, and I'm going to get rid of everything else here, so that we just see this put credit spread, it's going to better explain what our risk and potential reward is. Now, with any given credit spread, your potential reward is maxed at the credit you receive up front. You will be receiving a relatively low credit considering the risk that you're taking on, but the chances of you being right are higher. The stock in this case just has to move 0.03% for us to maintain all of our credit. So basically what you're looking at here, right here, the blue line is how much money we make if it is above 0. So our max gain here is at $111, which is 37 times 3. And our max loss here is $189, which is going to be $63 times 3 contracts, which is going to get you to $189. That's the max we can lose on this position. So our risk to reward is well defined by this P&L. And as you can see here, we are going to receive our total credit if we are above $413, and our max loss occurs at $412 a share. Now this is if we are bullish on the position, and basically with this risk to reward ratio, we need to be right more than we are wrong, because we are making more than a third given that the price is at $37 and our max loss is at $63. Now this is if we are bullish on the position, but we can be bearish on the position as well if we think it's going to continue lower, and then you can apply the same strategy. So let's say that we are actually bearish on the position, and let's get into a trade that would reflect that. What we can then do is get into what's called a call credit spread. So let's say that we think the stock is going to be below $412 at expiration. We think it's going to drop 85 cents at least. What we can do is get into a call credit spread with the $413 call strike and the $412 call strike. So what we would do is we would come over here, we would right click, we would hit sell, and then we would hit vertical. We are going to change our short leg to the $412 strike, and we are going to change our long leg to the $413 strike. Now in this case, we are receiving a credit of $62. That kind of credit shows us that we have a risk to reward ratio that is actually much more favorable. This is a contrarian bet. Pricing of the options is showing us that the market thinks it's going to move higher. But in this case, if you were to receive a $62 credit, if we were to analyze this trade, you can see that our max loss is $38, our max gain is $62. So we can actually be right 1 out of every 2 times and basically break even with this position. You could trade 2 of these contracts to get $124 in potential profit while only risking $76 of your money. And that's how you can trade and make decent money with a small account. Now, an example of when I got into this trade, you can see that I bought the SPY call credit spread for the 421, 422 strikes that expired in the 5th of May, and I collected a $31 credit. On May 4th, there was little chance that the stock was going to go against me, so I bought back my position on the short leg and I kept 99% profits on the position. That is using the strategy that I went over today, and that's how it worked for me. I was actually bearish on the position, and that's why I got into a call credit spread. When you are bullish on the position, you can get into a put credit spread. It's inverse of the traditional way of buying calls when you're bullish and puts when you are bearish. But that is essentially a strategy that can make you $100 a day or more in a small account by using options and trading the SPY. Now, like I said at the beginning of this video, you can do this on the QQQ or some other extremely liquid high volume equity. So with all that being said, if you have any questions, comment down below. Feel free to join the Discord server. A link is provided in the video description, and I'll catch you on the next video. It's been real, it's been fun, it's been real fun, and this is We Are Investing, and I'm out. See ya.